everybody. My name's Perry, and welcome to the second edition of Perry and Paul's Coffee and Cash Flow. We're going to call this the pre-Christmas edition since it's getting close, and I don't think we'll do another one till the new year.
So we're doing one on Christmas Day.
Yeah, we're going to do one right on Christmas Day, right after I have my Christmas pudding or whatever it's called. Oh, and we also have Paul's dog joining us.
Yeah.
So anyways, my name's Perry, and it's Perry from the PIIVerse, PIIVerse. And with me, we also have Paul Centauri from Better Call Paul. If for those people that don't know who Paul is, and that's very few people that don't know him. But anyways, hello, Paul. Good to see you again.
Yeah, Perry, how you doing?
Doing very good. It's been a busy few weeks since we talked last.
Yeah, it's been really busy. As you know, I tried to do 30 ETFs in 30 days for the month of November, which was, it was good, but it was a lot of pressure, a lot of work.
Yeah, I saw that. That was pretty good. It's like, so what did you think about going through the experience? What did your viewers think about your 30 ETF? Maybe an intro for the people that watches me. So what was this series that you were doing?
So I decided for the month of November just to do, it started out as doing one ETF each day, try to do like a 5-minute quick video, just go over one of the ETFs in my portfolio. But after a couple of days, I kind of thought, okay, this is boring. So why don't I mix it up a little bit? Maybe I'll do, for example, 9 Points Shopify, their ETF versus Harvest's Shopify, kind of compare the two.
Right.
One day I did a video where I said, is HHIC from Harvest the new EIT.UN from Canoe? Is it replacing Canoe now? And then one day I think I did all three of the Daymax series from Hamilton, right? Because they got C Day, S Day, Q Day. So, and then there was Tesla from Harvest versus Tesla from Yield Max. So yeah, it was fun. It was good. Did
it go over well with the viewers? Did they like it?
Yeah, what the funny thing is, some videos did okay, almost hit 1,000 views. But then some of the ones that, like ULTY, for example, I did an ULTY video and it hit like 9,000 views.
Yeah.
What I think is funny is that there's some ETFs where I think people should actually consider buying them, the TAP Alpha series, T-SPY and TDAC.
Yeah.
And, you get a few people watch. Then you do a video on ULTY, which probably nobody should own. And, you get 9,000 people want to watch it. So, and then, you wonder why there's so many content creators talking about ULTY.
So, well, because I won't call it clickbait, but it honestly, there's certain topics, especially in every community and including the income investing community, honestly, you've got the ones that are not only that are rock stars, but when they're basically doing some major bad things going on, it draws just as much, if not more attention when there's bad news stories about certain topics like ULTY and MSTR based ETFs and stuff like that. Yeah. So yeah, if a content creator as an income influencer wants to generate more views, all they have to do is talk about Misty and MSTE and ULTY.
It's actually almost hard to believe how they went from about, I think, 900 million assets under management to like over 5 billion within a few months.
Yeah.
Like that's how popular it became within a few months that anyways.
Yeah. And it's again, I mean, takes us into different circles all over the place. A lot of it is, so they did good marketing and they got good traction in the income space, in the social community and stuff. But the other biggest problem, and this is something we would like to talk about today, is the whole FOMO factor.
Yeah.
And it's those people that literally are, and again, I think this is what you and I really want to talk about today, is income investors that are new to DIY investing. First time they've walked away from their bank managed ETF mutual funds and said, hey, I want a piece of this action and I want to learn about this, and trying to drink water from a fire hose. But they watch all these Blossom and YouTube videos from all these people, and they hear this Misty, and they basically listen to their friends and relatives that say, oh, John, you got to buy an MSTY. You're missing out on some major income. And unfortunately, a lot of them jump into tactical investing instead of strategic investing, which is hold on a second. You don't go from being born to running the marathon. You got to first crawl, then you got to walk, and then you got to run. But too many people want to jump right to run, right? So, and that's why I think we saw a lot of that AUM skyrocketing going on with Misty and ULTY and whatever other ones that pop up that people are just fall in love with, right?
Yeah, and unfortunately, a lot of people got suckered into kind of like, buying these investments on margin as well. They figured, okay, if I can access $100,000 in margin and I can buy this much ULTY and Misty, and it's going to pay me $10,000-$20,000 a month, and then I'm set for life. And now they're getting margin called and they owe the bank money.
Yeah. It's sad. I feel bad because, and again, this is where I think, and again, I know you're a responsible YouTube influencer, and I know Adriano and myself and and a bunch of others are like that, trying to say, guys, you need a strategy. Do not just go buy, get a Wealthsimple account and go and buy your whole margin version of MSTY so you can do get rich quick schemes just because you've seen it on social media. You need to build a strategy. And again, one of the key elements to it, I think I brought this up to you once before, is it's like whenever you're going out to buy a house, the real estate agent tells you there's 3 things you got to know about buying a house. That is location, location, location. Well, when it comes to investing, and I'm not just talking about income investing, this is the same would hold true for growth investing. There are 3 things when you are doing long-term sustained investing. And those 3 things are diversification, diversification, and diversification.
Yeah.
And unfortunately, too many people just jump in saying, I'll diversify later. Let me just first get that Rockstar Misty or that Rockstar ULTY. Well, again, everyone bought when it was at its peak. And now you see the pain of making a decision, like jumping in before you even knew how to swim, right?
Yeah.
That kind of thing, right?
Yeah.
Yeah.
It is unfortunate.
It is.
Very
and I think, and I'm sure you're getting the same emails now with again, I just finished my November month end review.
Yeah.
And I called it the crypto chill. So that I gave it a nickname because honestly, it wasn't a full global downslide or bear market attack. If you noticed and you looked at the markets, generally the rest of the markets, they were flat. They were maybe a little bit down. There was ups and downs. But the real focus of the downslide, which people were really feeling, were the crypto chills and the tech chills. If you were into crypto, AI, or high tech, you were feeling it in those things. So I called it the crypto or crypto tech chill.
Yeah, I made a mistake in one of my videos. I think I was talking about the market crashing in November or whatever terminology I used. And somebody did, rightfully so, kind of correct me in the comments saying, the market's really not even down, right?
Right.
But my portfolio was down, and it was because of Bitcoin, because of MSTR, Coinbase. Those ones negatively affected me personally. And I think they probably made up for a good 70 or 80% of what my portfolio dropped.
Well, and people are wondering, like, again, I know when we talk, there's also not only those that are interested in supporting the income strategy or the income philosophy, but I know there's the negative Nellies out there that are pure growthers that are saying, well, see, I told you, this is what's happening. This is what's going to happen when they go into a bear market. It's like, okay, hold on a second. Totally true. If all you're going to do is go into any strategy, including an income strategy, and all you're going to do is put all your money towards the ultra high yielding, extremely volatile cover call ETFs, you're going to get burned for the same reason that you got rewarded when it was flying up and you were making huge 70, 80, 90% big dividends.
Yeah.
You're on a volatile ETF. So, but if you followed a more diversified strategy, this wouldn't be that bad. Like you and I talked about, it's like, my portfolio since October, so November was the crypto chill. Mine's down. I don't even know the number exactly, but I'm down about $100,000 on my portfolio, which it sounds like a lot of money, but it's not for my side because I reached a peak of over 1.7 million net NAV or current NAV. And I'm now I went down into as low as 1.55 million. So I guess I lost about 150,000. It's back up to almost 1.6. But the biggest issue, most of that was from the cryptos, the techs, those guys that went down.
Yeah.
I mean, if you look at some of my core base, and again, because I use high diversification, you look at my Canadian cover call ones, my core base, and I remember I did a video on core base versus yield base versus yield juicers. My core base was barely a touched.
Yeah.
Like it wasn't like you look at an ETF. I use it actually as the rock star for stability is Hamilton HDIV. I mean, call up its chart. If you looked at its chart for the last month and a half, you wouldn't even known anything happened in the markets at all.
That's right.
Like it kept going up, right?
I just started buying HDIV again. I had sold it a long time ago.
Yeah.
I opened up a margin account on Wealthsimple.
Oh, okay.
Yeah, I decided to open up a margin account and see how it works. To learn a bit about margin and maybe help some other people who are interested in learning about margin and kind of use it as a case study, step by step.
I'm going to be curious to see how that goes because I get asked this question at least once every 2 weeks, if not a couple times a week. It's like, Perry, do you believe in margins? Like, do you believe in leveraged investing? Borrow money from your HELOC or from a line of credit and use it to invest in these income strategies, right? And I was like, no, technically I don't, because again, why would I take a risk if I don't need to take a risk? Like I'm making more than enough money on my portfolio without taking the risk.
Yeah.
Again, some greedy people might say, well, because you can make more money. I don't need to make more money, so why I take more risk? But there are the people, and I have some, friends and relatives and stuff like that want to get into it, but they don't have that seed funding to do that kind of thing. And they're like, well, how do I get into it without having all the cash that some people have, like starting with 100,000 or starting with 200,000? And I'm like, if you really looked at it, and this is where you could likely enlighten me a little bit more, why not borrow money at a 5 or 6% rate or whatever number you have, and then just basically use it to invest in the most safe, stable cover call ETFs like HDIV, HYLD, ENCL, even maybe a little bit more aggressive ones like HHIS and Biggie.
Yeah.
And then basically have it just pay the maintenance fees, the loan interest, and pay down the principal. And one side of me says that's guilty because I'm sort of telling people they should borrow to invest, and I don't want to do that.
Yeah.
But then I turned around on the other side is that these are the same people that they're like, I don't know if I can afford to retire, but they're the same people that are taking out a $40,000 loan on buying a car, which is literally, I can assure you're going to lose all of that.
Yeah.
So it's like, why am I so concerned in advising people to borrow to invest? But I don't have any issue with them going with a decision to borrow $40,000 to buy a car.
Yeah. Yeah.
Yeah, but what's your thoughts about it?
Well, to be honest with you, Perry, I mean, and I'm not an expert at any of this. We're not financial.
We should say
advisors,
that we're both
right?
not experts.
But in my way of thinking, well, first of all, I was like you. I was totally against margin. I didn't want to use it. I didn't feel like I needed it. Just kind of do things on my own.
Mm-hmm.
And I think I've done well. You know what I mean? With what I started with what I had in 2020 till now.
Yeah.
Then I don't know if you noticed, but all of a sudden you got guys like Robin Haney are talking about using margin, and even Jordan is using margin. And I don't know if you know JJ, Convos with JJ.
Oh yeah, I know JJ.
He's using like $300,000 or $400,000 worth of margin.
Right.
Mind you, he's only 24 years old. Like he doesn't have a wife or kids or anything to worry about. But anyhow, I just started to think, especially they added it to Wealthsimple as well. You know what I mean? So it's pretty easy to do. But what I said, I think in one of my videos was, honestly, if you haven't been investing for at least 5 years, you haven't been in the markets, you haven't experienced some setbacks, some things like 2020 when the market crashed, or 2022 when the market was bad, this April when the market crashed again. If you haven't experienced any of these things and you really don't have a clue what you're doing, I would stay away from margin.
Oh, absolutely. Yeah.
I would stay away from it.
Yeah. I think that's the best first inexperienced advice, because I will put the precursor disclaimer in this video just to make sure people didn't know it if they're not hearing it from us now.
Yeah. Like
Paul and I are not experienced tax investors or financial experts. We're just two guys that like investing and just tell you your journey.
Yeah.
So again, keep that in mind. But from both our inexperienced advice,
Yeah.
it would be, I wouldn't touch margins with a 10-foot pole if you aren't already considering yourself to be at least a moderate to advanced investor.
Yeah.
It's just not for the faint of heart, because you got to know the only way to do safe margined investing is to know that what you're investing in is something that's safe, that can actually pay the maintenance fees of the loan, right?
Yeah.
And if you don't know what those are, or you think, I'll use Misty, well, look what happens when you use Misty.
Yeah.
And all of a sudden Misty goes down 70%. And it's like, so yeah, I totally agree. The first caveat would be is you better have a very strong comfort in understanding how investing works, and know how these ETFs operate, and know which ones would be considered really stables, like, you know, an HDIV versus a Misty, you know, or an ULTY.
Yeah.
So I totally agree. Yeah.
Yeah. Yeah. For me, it's not like I'm trying to make quick, easy money with margin. You know what I mean? If I could build up a small account and over time, you know, pay it off and then end up owning those equities, and it didn't really cost me anything because I used borrowed money.
Yeah.
Right? I mean, what's that guy? He wrote the book Rich Dad, Poor Dad. You know, basically explaining that the wealthiest people in the world do it by using
borrowing money
or borrowing money. So, you know, but I think you have to get to a certain level before. Well, not most people, a lot of people own a house, right? So you borrowed money to buy a house,
right?
And then you pay.
I think there's that one statement. Yeah, exactly. And I think that, I don't know who did it, but I did watch some guy, don't even know who he was, but it was basically based on the wealthy, and their strategy is borrow, buy, hold, die.
Yeah.
It's like they use other people's money.
Yeah.
They buy investments, they make money on those investments, and they basically maintain that cycle until you die.
Yeah.
So if you could do it as a wealthy person, why can't somebody that's knowledgeable, experienced, and understands what they're doing, why can't they move from I don't have enough money to retire to I think I could do this with a nice cyclical approach of investing, right?
Yeah.
And again, I'm going to say the same thing. If you're borrowing $40,000 to buy a car, clearly, I can assure you that $40,000 you invested in that car, you're not getting it back. You're getting very little of it back, right? So
So I started a couple weeks ago and I actually bought two of the funds you just mentioned.
Right.
HDIV being one of them, ENCL being another one.
Yeah.
And UTES. I bought some UTES.
Yeah, that one would be a nervous one. Like I can see why, but that one hasn't been like literally a NAV increaser. It's a stabler one, but what made you decide on UTES?
You know what? I bought UTES maybe a year or two ago. I can't remember when. And I think I bought it at one of the highs, like around $9.70.
Yeah.
And since then, it's been, I think, even below $9. But really, between about $9 and like $9.50, it just kind of goes up and down a little bit.
Okay.
Right?
I'll tell you right now, you finally convinced me to buy UTES. It's the one sector that I had not had.
No utilities?
I had no utilities, and I made a rebalancing decision just a week and a half ago.
Yeah.
Where I told you I was experimenting between HHIC and Canny.
Yep.
Well, I split some of the HHIC, put it to Canny, and I did some reinvesting in Canny. And then I thought to myself, you know what? Instead of having the two, I'm just going to close my position in HHIC because it's the lower of the two yielders.
Yeah.
And I'm going to use the money and I'm going to go into UTES. So I finally took your advice because I know it's a fan favorite of yours. So I now have UTES.
I do like, and you know what I think, Perry, and I could be wrong, but I think in the last 5 years, one thing I've noticed is that, you know, people make a lot of money in tech stocks.
Yeah.
But then when tech stocks crash or have like a correction, all of a sudden people pile their money into utilities, banks. What's the other one?
Yeah.
Utilities, banks, and oil, right? Like ENCL.
Yeah.
You know? Now, mind you, right now, it seems to be like everybody's putting their money in silver and gold, you know.
Which again, everyone looks, again, I feel that's a FOMO again, because honestly, you've got gold at all-time highs.
Yeah.
You know, and it's like is this the time you should be buying gold? It's like, honestly,
I know a
like
friend
you
of mine.
should be buying it when it was at 2,200.
A friend of
Buying
mine
it
a
at
couple of
40
weeks
something.
ago, he's like, "Oh yeah, I bought some gold," and I'm thinking to myself,
Yeah.
"Why are you buying it now?"
Yeah, I heard that video, and I was actually sort of, I hate saying, but I was shaking my head a little. It's like, why are you buying gold when it's almost at its all-time highs? It's getting close to the point where it's got nowhere else to go but down.
Yeah.
Right? So
yeah,
like right now, I couldn't recommend to anybody to get gold and silver. Like it's just not as a commodity, as a maybe as an income ETF where it can make good dividends on a volatile commodity, right?
Yeah.
But even that one, you got to be buying it knowing full well that gold doesn't have much more to go up. Now I could be totally wrong, and it can go up to 6,000, but it's hard to believe it can actually go past 5. But
yeah,
it has an easier way to believe that it's going to go back down to 3.
Who knows? It might keep going up.
Yeah, it might, but
when
you're closer to the top of your cycle, it's hard to go higher, right?
I think basically what I'm going to do to start is pick 5 different ETFs to put in my margin account, and try to buy. I only buy $500 at a time, and if the price goes down, like ENCL went down below $19, I buy more.
Right.
Build each position to about $2,000, so I'll have 10 grand in there. And then for a few months, I just want to see how it works. How much do they charge me in interest? It's like 4.45%.
Okay, you're doing an actual margin account. You're not doing like a HELOC.
No, it's a margin account. It's a non-registered margin account. Honestly, it takes about 5 minutes to set up on Wealthsimple.
Oh, okay.
Yeah.
So is that a better deal than a HELOC? Because you would think a secured loan would be a better rate, wouldn't it? Or do they give you better rates than a HELOC?
I'm not sure, to be honest with you.
I'm curious.
I'm not sure. I don't know. I mean, I don't really know too much about HELOCs, to be honest with you.
It's just a line of credit, but it's secured by your asset, like a house, right?
When we remortgaged our house, I think 2 years ago, we asked for a $50,000, I think, HELOC. We've never used it. We've never touched it.
I know. I'm the same way. I'm sitting on a HELOC that I'd never used.
I've never
used
an
emergency account. Right?
And I thought about going to the bank and saying, okay, look, if I pull out 10 grand from this HELOC, what's my monthly interest cost going to be? But now that Wealthsimple has it, it's just so much easier.
Right.
Yeah. I can go on my Wealthsimple account right now. I can pull up my margin account. You click on it and it tells you, if right now it tells me my margin health is good.
Right.
Right.
So when you do it, so how's your strategy going to continue from here? Is like, are you basically going to follow a strategy of do a full interest and principal debt pay down until it's 0? Or are you just going to pay the interest and live off of the fruits over top of it? What's your strategy?
Honestly, Perry, I don't even know, because I think this Friday is going to be the first time I ever get paid from the ETFs that I bought in my margin account. And I'm not, to be honest with you, I'm not even sure how it works. From what I understand, I think the money goes towards paying off the interest. Yeah. And it might even go towards paying off the principal.
Okay.
Right?
So it does it, or you have to manually decide?
I think it automatically does it.
Okay.
But then what happens is, say I borrowed $2,500 and I got $100 in dividends.
Yeah.
So I pay back 100. Let's just say I pay back an even 100. So now I owe them 2,400. Now my margin increases, right? Because I've paid off some of it. I get more margin access. Okay. Yeah, I'm not even sure, to answer your question, like I'm not even sure how do I pull money out of this if I want to actually live off of the money.
Well, and that's the bigger question I'd like to know. Like, it'd be interesting. I'll have to watch your videos, and anybody else that's interested might have to watch your updates on your experiment, because I'm not talking about a margin or leverage by a margin account, but let's say I just have a normal cash account and I go to the bank and I borrow $10,000 as a HELOC or whatever, and I put it in there.
Yeah.
The key part's going to be is, if you're, let's just say, a couple that basically doesn't have a lot of excess cash, you'd really like to maybe have 100 of it or 200 of it go back out so that they can help pay for phone bills and gasoline. Yeah. It'd be nice to see the cycle where the interest and the principal are starting to come down. Well, the interest is paid, the principal is coming down a little bit, and then there's enough left over that they could sort of realize the benefits of paying the gas and the utilities and the groceries, right?
Yeah.
So Versus basically saying, no, I don't need the money, but I'm going to use it as my investment seed, and I'm just going to let it cycle itself until it's paid off, and then it's all my investments. It's not the bank's investments anymore.
Yeah, it'd be interesting to see, like, if I take out $10,000 or $20,000 in margin and just use the dividends to pay back that $20,000 over, say, 2 years.
Right.
What, 2 years from now, the $20,000 worth of ETFs are now mine.
Yeah.
So now I could use the dividends to live off of, or I could sell them all and take all the cash.
Well, a perfect example of this, and I'm just sort of thinking this through. Let's assume you buy all the ones you said. Like, again, we're Canadian, so we're picking Canadian ones.
Yeah.
If I have my American investors, I just did a video showing here's a list of what I call core base, very stable NAV, very stable distributions. So they could use something like those that are generating, say, the same. Let's say on average they pick 4 or 5, because I still think you should diversify, especially while you're doing leveraged money. And they could get themselves to an average 15%, right? That would mean that if they would just turn around and say that all the money gets put in, let's say it's 100,000 they borrow. Well, 15% times 6 is 90. So just under 7 years, if they put it all back at 15%, in 7 years, that entire $100,000 would have totally paid for the investment, right? Am I thinking that wrong? But I'm thinking that's how it would work.
I think you're right. The only thing is that there'll be some sort of tax implications, right? Because it's all...
Oh, sorry. Yeah. If you're not in a TFSA, sorry.
Well, yeah. And I don't think you can have margin in your TFSA. I think it has to be a non-registered account.
You can use a HELOC.
What's that?
You can use a HELOC.
In your tax?
In your TFSA.
Really, eh?
Well, yeah, because TFSA means it has to be actual real cash going into your TFSA. Your HELOC is outside the TFSA. It's literally a loan. If I want to take out my HELOC and say I'm going to borrow 10,000 off my HELOC.
Yeah.
It puts 10,000 into my bank account. I can move that 10,000 into the TFSA.
Oh yeah, if you had room, right?
If you had the room. You had the room. But that's what the benefit of a HELOC is that basically it's just you're borrowing cash and you're just doing it similar to the way that I remember in the old days when mutual funds were around and you had the large mutual fund companies saying, hey, John and Mary, if you borrowed we'll give you a good loan rate of 6%. You put that all into our mutual funds and, RSP, whatever you want, we'll give you the tax deduction. So I think it's the same thing. It's like borrow money, create a cash balance, use it to put it into the RSP, get your tax deduction and stuff of the thing. So you're right. A margined account you can't do, but I bet you can do it with a HELOC.
Yeah.
And again, I could be wrong, but I can't see why you wouldn't. It's borrowed money, right? So so
I think so.
Anyways, it's something to talk about. It's interesting path you're following.
So what after our crypto chill November?
Yeah.
Do you have any predictions for December? Are we going to have a Santa rally? Are things starting?
Yeah, that's interesting. It's funny you said that because I actually did a survey question to on my members saying, what are your thoughts about this? Is like, do you feel that this is a chill that's going to get worse? Do you feel it's a chill that's going to come back before the end of this year? Do you think this is a precursor to something worse? Right. So, and again, I haven't looked at the update, but I'll actually, while you're talking, I'm going to call up my survey because I'll tell you what the results were from it.
Yeah.
So you tell me your prediction first while I find it.
I think things will get better towards the end of the year. I don't know about come January, if usually after the Santa rally, we have a bit of a drop in January, but I don't know about you, but I've noticed that December usually tends to be one of my better months. Historically, anyways.
Yeah, they call it like the Santa rally type of thing, right?
Yeah, but dividend wise, I seem to do well in December, so we'll see.
Okay, so I got the results here. So gut feel from the people that did my survey, we only had 33 votes, so it's not that much. 76% said the chill is isolated and they believe it's going to recover before the end of the year.
Okay.
24% believe that the crypto tech chill is the precursor of a much worse 2026 bear market.
Oh, wow.
Yeah. Nobody said that the crypto chill is isolated but getting worse. They think either it's going to get better or the whole market's going to get worse, and the crypto tech chill is just a precursor. So
Yeah.
my personal gut feel, and I could be totally wrong, and I'm likely am wrong, is I believe in the 24%. I have a feeling that 2026 is going to be a bear market. It's not going to be one of those like amazing, great hitting all-time highs in the markets. I think there's too many macroeconomic disruptors out there, like the tariffs and the instability in the American markets. That's going to, and again, when the United States sneezes, everybody gets a cold. So I think we're going to start feeling the aftermath of that kind of stuff. So my gut feel, I hate to be a negative Nelly, but I think we're not going to have a great 2026. I totally hope I'm wrong, but if I'm right or wrong, it doesn't matter. I think that's a good thing. So if you're the kind of person that believes that it is going to get worse, but even if you're not, if it is going to get worse in 2026, I get a lot of people asking me that question. It's like, so Perry, well, what are you going to do to get ready for it? Right?
Yeah.
Like, are you going to make changes to your portfolio? Right now it's very aggressive and stuff. And my answer back to them for you can tell me your side too, is no, my portfolio is already heavily diversified. I have 35 covered call ETFs in Canadian and American markets. I have from very conservative to very yield juicers to the yield basers. And so again, I will ride it out. Basically, I use that 3 times. I think we talked it before.
Yeah.
My strategy is that my income basically generates at least 3 times more than I need on a monthly basis. And it's right now at over 4.5 times. So my answer to them is I'm not going. I am ready. I'm ready for the markets to get worse.
Yeah.
I already know my distributions will likely go down. And somebody called me out on it. They said that I would go down by as the equal. I've said they would go down equal to the NASDAQ. But somebody even said, well, Perry, if you've invested in the base ETFs, the base core ETFs like the HDIVs and the HDIF and the HHISs, some of them didn't even notice anything on the techno chill. But even if they go down a little, is the distributions even going to be affected that much? And I think the answer is no, they're not going to likely be affected. You never see Hamilton really go down 6 cents. They go down like 0.1, 0.2, right?
Yeah.
So yeah, the answer for me is I'm already ready for the bear market. I already expect my distributions are going to go down, and I'll just ride through it. So, and you?
Yeah, well, my portfolio is a lot smaller than yours. And so what I'm trying to do just to get ready for, say, the worst case scenario is focusing on those, well, I call them defensive position. I guess you call them your base core.
Base core, yeah.
Right? Or even, I think Adriana likes to call it your foundational position.
Right, foundationals. Yeah.
So what I've been doing is I've been kind of taking some of my my ultra high yielders, when I get the dividends from them, and putting the money into stuff that I think is a little bit safer, maybe doesn't pay as high of a yield, but the yields are more consistent. They don't get cut all the time. They're not up and down. So that's what I've been kind of doing, is just working on those core foundational ETFs. Kind of like,
and it's funny you said that, Paul. Very good. I'm glad you pointed that out, because for 2 reasons. One, that's sort of what I've been doing. So all my distributions, if there's anything I'm getting ready for, I'm not getting ready for it. I'm basically adapting to the fact that, if the bear is coming, why would I start investing? Why would I keep reinvesting in ETFs that are already expected to have a pretty volatile down market?
Yeah.
Right? Like, why wouldn't I take my reinvestments now and move them into the foundational, base core, whatever you want to call them, the stable guys?
Yeah.
And I've already been doing it. I've moved a lot of my investments, very few of them. I still do some reinvesting in the juicers.
Yeah.
But I'm focusing a lot more on the all-in-ones. I call them the all-in-ones, the index, the sector ones, so that there'll be a more mitigating the volatility. And I'm doing that kind of investing that way. Yeah.
And I was going heavy into, say, something like HHIS, right?
Mm-hmm.
But it's all American, right? And it's all mostly technology. So instead, now what I'm trying to do is, okay, I've got almost 6,000 shares of HHIS. Maybe it's time to start buying some HHIC, pick up some
Canadian.
I consider the Canadian companies to be a little bit more
Conservative.
conservative, right?
Yeah.
And they're in different sectors. They're not just
Right.
technology. You know,
Yeah.
you have
And that
you have Shopify, and that's about it for technology. So
right.
you know, and
Well,
then
and that's the thing. That's the benefit. For example, I mean, as an example, that's why I bought Utes.
yeah,
I got Utes because I never had any Canadian utilities. So I thought, okay, I'm going to get Utes so now I can put my reinvestment money into something like Utes or more into HDIV or more into, Canny or those kind of things, put that in. But yeah, you're right. I think there's nothing that I have to change my portfolio to get ready for a bear.
no,
I'm just saying, like, when you see the headlight of a train coming at you, why would you try to run right for it? Why not try to take a couple side tracks and
yeah,
start moving the money into like putting new money into something else, not selling, because that's actually a good point we want to both bring up. You don't, especially when you're income investing. And again, because as an income investor, our covered calls have NAV lag, right? I get very few have anything but NAV lag because in order for them to basically do cover call contracts, they can't keep up with the underlying.
right,
They'll try, but they will lag a little. But there are some that are eroders, like for example, the Conies, the ULTYs of the world, and that basically you might be actually in a capital loss position.
yeah,
Well, honestly, don't sell it and realize your capital loss and move it to something else. If you want to prepare, just start reinvesting in the safer ones and just, increase their weight position as
yeah.
opposed to selling it and moving it over there, right? So
I was, I think, closer to 45, maybe 46 positions.
yeah,
So I started to streamline a little, try to find areas where I could sell an ETF that maybe had more single stock risk, right?
yeah,
But
right,
sell it at a time when I was in the green, you know what I mean?
right,
And could
right,
sell it for a profit. So what I did,
right,
for example, was I moved all my shares from NVHE.
right,
I sold them all in
yeah,
I had them in two different portfolios, but I sold them all in one portfolio and I moved it all into HHIS.
right,
And I
right,
was able to sell it at a time where it was worth more. So it was actually higher,
right. Yeah,
right?
you're realizing the capital gain. Yeah,
But also, it was paying 22 cents.
right,
And I think at the time, HHIS was paying 26 cents.
right.
Now, NVHE, of course, after I sold it, they increased their dividend, right?
Yeah,
What they make it 25,
yeah.
right?
But I think HHIS went up too,
It went up to 27.
27.
Right?
Yeah,
So, and I still have NVHE, right?
yeah,
I still have
right.
it, but it's inside HHIS,
Yeah.
right?
Well, and that's why a long time ago, as soon as they released HHIS,
Yeah,
I made the decision of saying, okay, I'm going to invest in positions that are greater than what HHIS holds, such as the MSTEs, PLTEs,
yeah,
CNYEs.
yeah,
But I actually sold any of the harvest positions that had a yield lower than HHIS,
right.
like Eli Lilly and like NVHE. I got rid of those and I basically put them into HHIS because it's in there. Plus, I get more yield. Why would I?
Yeah. So,
Why would I hold a lower one? Why don't I just put it into HHIS? Right.
yeah, and I ended up selling LLHE and moving it into CNYE, right? So
Okay. Yeah.
because LLHE cut their dividend, right?
Right.
They cut
Right.
it from I think 18 cents to 16.5.
Right.
So I ended up selling it and moving it into CNYE that pays like 40 cents.
Right.
And
Exactly.
again, guys, just remember this is what Perry and I are doing. Doesn't mean you guys have to go and sell all your favorite funds, right?
Yeah. Yeah. No. No.
My
No. Like we all do. You're right, Paul. Like we're just doing what we think is a good rebalancing strategy for us.
yeah,
We're giving you our logic behind why we're doing it. So
I
a good
keep
thought
track.
you said.
I keep track of all my dividends, right, in my spreadsheet. And
Right.
now with all these American funds paying weekly, it's
Yeah.
it's too much, right? So
Yeah.
I'm really trying to bring down my holdings to a what I consider a more manageable
Yeah.
number for myself. You know,
Right. And I think you brought up a point that I'd like to reiterate. I said that you shouldn't sell your juicers at a loss,
yeah,
but that doesn't say you can't consider selling a juicer that might be higher risk in a bear market at a profit,
hmm,
and then to use the profit to actually use that as an opportunity to move to something more stable.
yeah,
It's a hard thing to do because in order to sell a juicer, you're walking away from a higher distribution, right?
yeah,
You're walking away from a 60%er or a 50%er and moving down to a 20%er, but you're moving to a more stable 20%er, right?
That's right.
So
Yeah.
again, this is why it's not a science. We could give you guys the science of options you could look at, but at the end of the day, it comes to a personal decision on risk, on stability, on your gut feel. So it's a mixture of gut feel and science. Like, yeah, I sold Canny. Again, that was an easier decision for me because Canny I already had. Oh, sorry, I sold HHIC.
Yeah.
I had HHIC and Canny. HHIC, and I only held it for 2 months, but I already had a profit on it because it actually went up.
Wow.
So
yeah.
I sold it for a profit, didn't get much distributions, but at least I sold it for a profit plus distributions and got to get into a new sector that I've never had. So that was my strategic reason for doing that, right?
Yeah.
Right.
Yeah. And I think as I was trying to get my monthly income to grow and grow as fast as I could, right, I really leaned on those higher yields. You know what I mean?
Right. Yep.
I had funds like HDIV and HDIF and BMAX. I had them all.
I did
They were
too.
all in the green, but it was
Yep.
like, okay, now if I sell my HDIF and I buy NCL that's currently paying 20%, my monthly will go up by $300 a month. So that's what I was doing then to get me to 10,000 a month. Now that I'm at 10,000 a month, I want to make sure that my, like my boat is safe. There's no holes in it. It's going to float. You know? And
that's funny. Yeah, it's exactly funny that you said that. Is like once you feel like for example, my income levels are. Remember, I told you one of my strategies and one of my goals is that I had to have a portfolio that generated at least 3 times my expenses. Right. Well, now that I'm at 4.5 and 5 times my expenses, this is gravy money. So what it's helping me do is
start
grow.
Spending more money, Perry.
I got to spend more money. I got to do more vacations. So, but this changes my whole philosophy now. It's like, okay, I've reached that number. Maybe I should now really focus more, not on income growth, but more on stability, right?
Yeah.
Buy more of the HHISs and the Evolve, ENCLs and again, for Americans, the American counterparts of foundational ETFs that give you a lot more stability, a lot more long-term sustainability, because I'm already meeting my income monthly distribution goals, right?
And buying stuff like for Americans, for example, like you're saying, I really like Tap Alpha, so I buy T-SPY and TDAC, and 14% and a 17% yield is nothing to like cry about. You know what I mean? Right. Like I think if I had to take all my money and go and put it into something like Johnson and Johnson and get 2%,
I know.
You know what I mean? So I don't think there's anything wrong with getting 14 to 17%, especially when if you look at their share prices. Their share prices are, they're I don't know, they're like gold, I guess. You know what I mean? They're solid. Yeah. They just.
Well, and that's funny you're saying it because that is a question because I just finished for any of your viewers. My channel, I just finished a major research project that started off by the Americans asking me what are American equivalents to Canadian core base ETFs. Again, we call it like foundational. So in my video, I talked about what is core base, what is yield base, and what is yield juicers. And core base for me in my video is basically any ETFs that are very stable NAV and distributions under 30%. Generally, even under 20%.
Yeah, I think under 20 for
foundational. Under 20 to me is safer, right? But I gave it a window up to 30 so that maybe like an HHIS and some of those can fit into it.
Yeah.
But you're right, it could even be a 20. So I created that list. I created a new video. I got actually, thanks to all my viewers, I actually built a big list for my American viewers. Nice. Tap Alpha was clearly one of the biggies. NEOS. There was also Amplify had a huge list, but there's several others. So anybody wants to see that video, go ahead. People ask me, well, Perry, if these are that good, why are you as a Canadian not buying them? Because, and again, obviously I know my reasons. I'm a Canadian and I've got cover call ETFs in that space that literally we Canadians dominated. Like I'm proud to say that the Canadian cover call industry dominates that core base landscape. And I said, why would I do those if I didn't, and pay it and why would I buy an American one if I have to pay the 15% withholding tax?
Yeah.
You say you do buy some of them, so maybe answer the viewers, why would you buy an American core base when you could buy a Canadian one?
Well, for me, I started out a few years ago putting money into a US account just to buy some stocks. Like this was back when I was still more of a dividend growth investor, right? So I was buying some stuff like Pepsi. It's been a while now. I can't even remember which stocks I was buying, but I was buying some of, even SCHD. So I was buying those type of US stocks. And then when I decided to sell out of them, then I had all the money left over. So I started buying Yield Max and Round Hill, those type of funds, Defiance.
Yeah.
And now that I have those ones, and some of them are doing well and some of them aren't doing as well, I just use the dividends. I decided to start putting the dividends into funds like T-SPY and TDAC because I think in the long run, they're going to outperform.
Yeah, they will outperform with an ROI better, And the thing is, because you already had an American account, you're using American distributions to do American rebuys.
Yeah, for sure. I mean, if when I was doing it, certain companies like Harvest and Hamilton and Evolve didn't have the ETFs they have today, right? We're spoiled for choices now.
Yeah, we are.
Yeah. So
but you're still being hit, unless you're in an RSP, your US account, if it's non-reg or TFSA, it's still getting hit the 15%, even if it's an American account. You'll still be hit the 15%.
Correct. Yeah. So about 95% of my US funds are in an RSP.
Oh, so you'll be safe.
So they just pay you the dividends and you don't see anything. But I have a small account in my TFSA and you see it, right? It'll be like they pay you $20 and then it's -3, or whatever the 15% is, right? They put it in there. So you see the money you're losing.
Right.
Right.
See,
actually,
I use RBC. RBC hides it. I don't know if I want to see it or I don't want to see it, but it would be nice in my TFSA account to see the 15% taken off, saying 15% withholding, withdrawn from this income.
I only have one in my RBC account. I have ULTY in my TFSA, and you just see the dividend. You don't see how much they keep.
Yeah, that's me. That's it. Well, and I don't even see the exchange rate. Like I have to calculate it myself because all my TFSAs, RSPs, all the distributions I get, even my US holdings are all in Canadian converted cash. So when somebody offers like a 10-cent distribution, I'm getting 40% more than 10 cents. And it just shows up as a bulk amount. It doesn't say, oh, Perry, you were going to get 10 cents, but you're actually getting 14 cents.
Right.
And here's your 14-cent distribution. It's sort of obscure, right? So
what I think I'm going to do moving forward, actually, I realized this week is probably not a bad idea. And I did it for a little while with HYLD.U, but it doesn't pay very much. So I think what I'm going to do is I'm pretty sure you can get HHIS.U.
Okay. Yeah, that'd be good.
So now in my TFSA, I can use my dividends to start buying that, and I won't get dinged with the 15% anymore.
On your TFSA?
Yeah.
You'll still get dinged though because it's HHIS.
Yeah.
Yeah. I'm not sure about that one, but yeah, that sounds reasonable that you wouldn't get dinged because it's coming from an HHIS, a Canadian. They've already paid that 15% overhead.
That's right.
In their internals.
That's right. They've already paid it. Like when HHIS says that they're going to pay you 27 cents, you get the 27 cents, right?
Yeah.
They've already paid any taxes that they have to pay is already done.
Yeah, this isn't a loophole for anybody who thinks that they're going to avoid 15%.
No,
it's already taken out of your net distributions from HHIS.
And I think it's only on dividends, right?
Yeah, it's only on dividends. Yeah.
And a lot of those tech stocks don't pay dividends. So
no.
And I don't anyways.
Yeah. Your distributions count as well. But there's a lot of that thing about ROC, right? Because the 15% withholding tax does not include, ROC is exempt from that 15% withholding tax, right? So again, this became a big kerfuffle in the Blossom community. Are the people that are, for example, like Wealthsimple, where they don't actually refund you back your ROC portion from the previous year. That's a big number if you've got a big account, right? So if you've got a bank brokerage or a brokerage that actually honors ROC refunding, it's a big number, right? So, but if you do it or if you don't, just keep in mind, ROC is not included in that 15% withholding. So anybody that collected that entire distribution, somebody has to pay it back to you. But in some cases, and I think the way it works with Wealthsimple is they're like, go to the IRS, they'll give it back to you, right?
Oh.
In other words, we gave them everything. If you want it back, talk to your tax accountant and you figure it out.
So
and
with RBC, right? I have
Yeah.
ULTY in my tax-free savings account.
Yeah.
They're going to send me my ROC. I have to apply for it.
Nope. No, it's all automatic. It's so quiet that when I called them and asked, how am I going to get my refund? The analyst wasn't even sure how it worked. They had to actually talk to a superior.
Yeah.
And she came back and said, it's actually been given to you already. Look at your March monthly statement.
Yeah.
And if you look in the March monthly statement, there's refund. They go through every distribution you got for the previous year and give you the ROC portion from every distribution back.
Wow.
It was like 3 pages long, because they don't just give you a bulk number. They said because the ROC is different for every distribution. So they literally have to use the tax, like for example, Yield Max and Defiance and all them. They have to do an end of year tax supplemental or a tax. There's a word for it. My brain's off on it. Where they literally at the end of the year saying, okay, we've finished our year end. Here's how it works. And here's basically what the actual ROC was, because they only estimate ROC.
Yeah.
When you ever see that, oh, you're getting 48% ROC, those are very conservative estimates. That is not your ROC.
No.
The ROC is at the year end when Yield Max goes through it and says, nope, for that distribution on November 12th, it was actually 22%.
Yeah.
It was this. The banks in Canada will get a copy of that document, that report, and then they go through the complex process of saying, okay, now we got to give the clients back that actual percentage, right? That's why they can't give it back to you to the year after, right?
Okay, gotcha. I don't think
and it's very complex, so I can actually see why maybe a smaller discount brokerage like Wealthsimple, they just don't have the IT staff yet to sort of deal with this, and they're a little bit scared about how do you deal with this, right? So
yeah, could be.
Yeah. Anyways, sorry, I didn't want to start up another hornet's nest because I know it did, but I think it's important for viewers to know that ROC is not something that you're taxed for. You should be getting that money back, and you better figure out, talk to your tax accountant, but you should be getting that portion back, right?
Yeah.
Yeah. Okay. Yeah. So the other thing is we talked about, you said that refund, not the refund, the rebalancing and the distributions and the reinvesting. I've been talking to a couple people. I've been sort of mulling it over, but I think over the next year or two, I'm going to be slowly changing my allocations. Like I basically do have a core base, a yield base, and a lot of yield juicers. They are the ones that give me a lot of the income.
Okay.
But I really think I'm starting to believe a lot more and moving more towards a conservative strategy.
Yeah.
And I think what's going to happen over time, and maybe throughout 2026, I'm going to be starting to wean off of the yield juicers and focus more on having more of the US yield, the yield bases.
Yeah. The
ones that are like all-in-ones, indexes, sector, like the WPAYs, blocks, the ones that are basically like YSPY. If it's one of those three, I really like that. And I think you were saying you wanted to actually bring it down from 40, whatever. I'm in the same boat. I'd like to, over the next few years, go down from 35, maybe down to about 25 or 20, of which the juicers sort of disappear and the income, the yield bases actually start becoming more prominent.
Yeah. Yeah. That's exactly what I want to do. I don't know about you, but I started buying, WPay, blocks, MSTW, I think YBTC. It seems like I started to buy them and they just started every week dropping in price.
Yeah.
Right.
Yeah.
Just dropping in price. And then of course they dropped in price. All the distributions dropped as well. Right.
They go with it. Yeah.
Right. So,
and people need to know that, right? When the price of those cover call ETFs drop, the distributions go down with it. Because they're dropping in NAV because the underlying is dropping in price. And when the underlyings are dropping in price, then when you write contracts against them, you're getting less of a premium or proceeds from those. So there's no choice for their distributions to drop down with the drop of the NAV, right? Because you can, if your car is this big and you do write insurance for this big, versus if you're this big, you're going to be getting premiums based on the size of the underlying, right? So
that's it.
And the other one is volatility.
Exactly.
Also, you get
price
volatility.
and volatility are the two most important things, right?
Yeah. So it is a little bit discouraging. I think we all got to talk about the keep calm. When the markets are chilling, people got to chill, right? Like,
Well, I think that Adriano has said it best in the past. Everybody loves investing, and your portfolio looks great in a bull market when things are going well. But it's these times where your portfolio is hurting for whatever reason,
right?
Where you kind of get to really assess how your portfolio works. What works, what doesn't work, or even just how it's going to react to certain market conditions, right? So,
for the new investors out there, and again, I have, like, for example, my sister, she started in July. Now, the good part is I've kept telling her the entire ramp up period is that you got to diversify. You got to make sure that you're understanding that we're at all-time highs right now. You're buying things right now that are at their peak. There's not, if you're at the top of Mount Everest, if you go in any direction, the next step is likely going to head down, right? So
true.
So it's for those that haven't had that kind of mentorship and stuff. We're trying to tell you on our YouTube channels, like, the markets have ups and downs. Your portfolio will have ups and downs. If you're a growth investor, you know what that means. That means your unrealized NAV growth is going to go into drops or losses. You know what? For the same thing happens on the income portfolios. You're going to get a NAV drop, but you're also going to get distribution drops. This is why a good strategy will let you sleep at night. I don't lose any sleep at night because, I know my distributions will go down, but I also know that eventually the markets will eventually go back up. So, but you said it absolutely right. It's during these stress times like this crypto chill and the tech chill, and eventually Mark, I got a phone call. So, and market times like this where things are stressed, this is the perfect time to evaluate your portfolio and sort of say, wow, look at that. I didn't actually notice that, when I'm starting to be under stress, that I'm really hurting a lot on the yield juicers, or maybe I've got too much crypto, or maybe I should start diversifying and moving things. This is the perfect time to start evaluating and rebalancing and strengthening your portfolio for the next cycle, right?
I've actually been really impressed with HYLD. It was a little over $15 a share, and it's hardly come down. Like, it came down a little. I honestly want it to go back to $12 because I want to buy more cheap. And it just won't do it.
And it's funny, and I'm going to turn around. I think we're both going to tell you, like, we're going to tell our audiences, we have no sponsorships or no affiliations with any ETF companies. So if anyone thinks we're saying these things to promote these companies, we're not. Hey, call us. We'd love to sponsor. No, I'm just joking here.
You didn't watch my video yesterday.
No, which one?
My portfolio reveal for the month of November.
Oh, I think I did. Yeah,
I was sponsored by Harvest.
Oh, I didn't know that.
Yeah.
Okay, I lied to you.
Yeah.
So now, see, you're a sponsor.
The funny thing
I'm
is,
still a nobody.
I was sponsored by Harvest, and I'm really happy about it because I love Harvest. They make up the largest percentage of my portfolio from any one individual like ETF provider, right?
Yeah.
To sponsor my video, they didn't even say I have to talk about them. They didn't, like, there's no, if you watch the video, there's no advertisement in the video for a Harvest product. All I had to do was just be transparent. The video is sponsored by Harvest. Right. And then you have to include their disclaimer, right? Because they're sponsoring you. But other than that, if you go back and look at I think I've done 4 now. 4 monthly portfolio reveals, right? Because we started at the same time in July. So I think my first one was August, right? August, September, October. If you go back and look at all 4 of them, they're basically the same format. Nothing changed. So,
Yeah.
Yeah.
So I missed that.
I live very close to Harvest.
Right.
They're about a 25-minute drive from me. So
Oh, okay.
I got to go and meet Michael Kovacs.
Oh, did you? Oh,
Yeah,
cool.
yeah, it
Yeah.
was fantastic. He was really,
Yeah.
really nice to sit down and chat with him for like 15 minutes. And, he asked me, how did I, end up starting our channel and,
Yeah.
all that kind of stuff. And I went through the whole spiel about how, back in 2019, I had a financial advisor from I can't even, there's not the cooperators. Anyways, wherever
Yeah.
investors group, right? I had my financial advisor and got rid of him and, took over my own portfolio. And,
Yeah.
now here we are today and we're on YouTube.
Well, and it's funny you say that because honestly, like, yeah, we were supposed to meet them in Toronto too, but we were all too busy to actually meet them in Toronto, right? But
Well, we met
um,
with Avanesh.
yeah, we met with Avinash, but
Yeah.
we didn't. We were supposed to go to their site and stuff, but the timing
Oh,
wasn't right.
yeah.
Yeah.
Gotcha.
But the and that's why I say, like, for example, I have no sponsorships, not with an ETF manager. I actually am now an affiliate for Snowball Analytics
Nice.
for the same reason. It's because I've been using them for 2 years. It is my one of my go-to websites to do that. So
Yeah.
yeah, all of these sites have their pros and cons, and Snowball Analytics is no different. But I've loved it all along. And they basically said, look, you're generating a lot of free months because of just by promoting it, and you're not even doing it. So
Yeah.
I actually joined them as an affiliate. So, and I did it not because they asked me to, it's because I actually believe in their product and
Yeah.
I use their product on a monthly basis. I use it in my videos too. So that's my only sponsorship I have. It's not a sponsorship, it's an affiliate, right?
People probably don't realize, but we get emails all the time, right? From people who want, I get emails from people who want to edit my thumbnails, they want to edit my videos, but then you also get videos from people who want to sponsor you, right?
Yeah.
I think Moomoo's a big one, right?
Yeah.
Well,
oh wow.
I mean, I don't use Moomoo.
No,
right?
I would never sponsor anybody that I don't use.
Like if Wealthsimple ever reached out to me and said, "Hey, Paul, we know you have a channel. We would love to sponsor you." Well, I've been on Wealthsimple since 2020,
Right.
And the one thing I'll always say about Wealthsimple is in 2020 it was crap, like it was terrible, but it was free. You know what I mean? I was paying $10 at RBC, and Wealthsimple was free, so I joined it like everybody else.
Right.
But since 2020 to today, they modify their app about every 3 to 6 months, and it just keeps getting better and better and better.
Right.
Like,
and that's what I try to say when I know we went on a tangent there, but that's what I was trying to say. For example, you look at when we keep mentioning like HYLD and how solid it is. I have to say, I bought I think the number 2 ETF I bought way back in 2023 after I bought HMAX from Hamilton. And that's what got me into passive income investing.
Yeah.
The next one was HDIV. Now,
Okay.
I still hold HDIV. I've held it ever since. I actually reduced its position. I shouldn't have. I mean, when you look at it, I mean, you're talking about a rock star on stability. I mean, I just ask anybody to call up their chart and look at their last 2 or 3 years.
Yeah.
I mean, they just keep going up and up and up and up. They hit that one tick with the Liberation Day, which I wish I would have known because it went down big time like everyone else, but then it just flew right back up again. So that's what I like about the stable ones is that they basically, you can sleep at night when you're buying, anything under a 20% yielder, right? So,
and I mean, HYLD's been a journey, right? At one point, HYLD was, I think, the largest position in my portfolio. I think I had about $75,000 in it.
Yeah.
The problem was their distribution was about 14 cents.
Yeah.
They cut it to 12 cents.
Right.
Which hit me hard, right? Because it was a big portion. I think it was about 30% of my portfolio at that time.
Yeah.
So that's when I decided I don't want to have any one fund be that large in my portfolio. Right. But, if you look at what HYLD's done since then with all the changes they've done to their holdings, and now they're paying 15 cents.
Well, and again, for people that say, well, look at them back in 2023, 2024, people have got, anyone who doesn't know Hamilton on those ETFs made some major fundamental internalizations and shifts that basically they took full control of their underlyings.
Yeah.
Like literally, I think if I remember, Adriano actually calls it 2.0, like
Yeah,
HYLD 2.0
I
or
think now we're at
HDIV 2.0.
3.0.
Yeah,
Yeah.
like they've done so many great improvements that made their ETFs so stable.
They
And again, I'm
also
only saying it because of results. I'm not saying it because I'm sponsored. I'm saying it just look at the charts.
they also launched in 2022, I think.
Yeah,
So that was the one bad year, right?
yeah,
So
yeah,
they launched at $16, and it was only within a few months it was down to like $10.
yeah.
You know?
And that's where I lucked out because I started investing in 2023. You know, HDIV, HMAX, and HYLD were all down. HYLD were all down.
Yeah,
And I was like, okay, I'm going to keep buying. I'm going to keep buying. And then basically they just went up from there. Like, I'm glad I did buy that position. I should have actually held it longer.
yeah,
But I did reduce the positions. But yeah, so yeah.
yeah.
But anyways, yeah, that's about it for that. What we're getting close. We won't likely see each other or do a video because I'm not doing the Christmas one. Sorry. So what are your plans long term for 2026? What do you think you're going to do with your portfolio in 2026? Or is it just more the same?
Well, yeah. So for at least for December, I'm going to continue looking for opportunities to streamline. I honestly, I don't know if I can get down to 30, but I think 30 might be where I feel comfortable in terms of
Mhm.
holdings,
Yeah.
and just keep building out the foundational ones. Keep adding to the base ones. More so than any of the high yielders. That's
Right.
and try to balance out my portfolio so that it's not so much tech heavy, right?
Right.
Because if we do have a significant tech crash,
Right.
not just Bitcoin and MSTR, but a real tech crash, that could
Right.
hurt a lot. So
Right.
yeah, just keep building my base. 2024, I'll probably 2024. 2025, this year I'm taking 20,000 out of my portfolio, which is more than I've ever taken out.
Yeah.
Next year I'll probably increase it a little bit.
Right.
And yeah, that's about it. Just keep I don't want to add too many positions. Oh, I know what I was going to ask you. What do you think of Evolve's new SIXY?
I I'm intrigued by it for the same reason as I was intrigued with Biggie
Yeah.
as a counterpart for HHIS. But I'm a huge bank fan.
Yeah.
So again, I think somebody introduced that SIXY was coming,
Yeah.
and
It
and it has
launched.
a little bit better yield than bank does. I think bank's at 16 or 17. This one's my understanding is going to be 20%.
Yeah.
I'm not the yield difference is not enough for me to say maybe I'll like what I was going to do is I have my largest position in my portfolio for ETFs is bank. So
Wow.
I could cut bank in half and basically instead of like 7%, I could do 3.5 of that and then put 3.5 into SIXY.
Why not,
So it
why not
might
just buy SIXY with dividends?
well, yeah, that's the thing. But I'd like to have an initial position, and since SIXY and bank are very close
Yeah.
as part, close in their thing, it'd be nice to have some seed funding on SIXY.
Yeah.
And then it would also allow my bank to actually be down to my 5% rule. Because I remember I have a 5% rule in my portfolio strategy, and that is no cover call ETF should have more than 5%. I do break that rule with a couple. That's one of them.
Yeah.
So it'd be okay if I maybe dropped to 4%, use that excess with the proceeds because I've got good capital gains on it, trim the gains, move it into SIXY, and then decide, start adding more to SIXY. So
I loved
I haven't
bank,
decided yet.
loved bank, but I sold my entire bank position and put the
Yeah.
money into Canny.
Okay. But those are two different. They're a little bit different, aren't they?
They,
Canny's got more than
they,
bank.
they are different. Well, Canny's more diversified than bank,
It's diversified. Yeah,
right?
it's a
It's
lot
more
more diverse.
diversified because it's not just financials,
Right.
but it also pays a higher yield,
Yeah.
pays twice a month.
Well, that's the part I like about SIXY.
Yeah.
That's why I think
And they're all from
Canny
Evolve, right? It's not like I
yeah,
didn't abandon Evolve. You know what I mean? I didn't sell off bank and go and put it into, like
well,
Yield
that's
Max
what
or
makes
something.
me wonder why Evolve would actually put out a product that actually competes against itself.
But you know what? You're going to have people like yourself who really like bank, right?
Yeah.
They have it. They've had it for a long time, and they probably
True.
feel safe with the distribution. And then you
Yeah.
have other people who are like, "Yeah, I want more. I want
Yeah.
20%." Yeah.
Well, and that's where again, we don't have any say with Evolve, but I'm a little shocked that they would have turned around and not done, for example, what YieldMax did. They moved from monthly to weekly, right? Why didn't they just take bank and say,
I don't think
we're
they
going
can
to
do
totally
weekly
change
in
it?
Canada yet.
Huh?
I don't think they can do
No,
weekly in Canada yet.
no, they're not. But they could have taken bank. Again, they must have some regulatory. They could have taken bank and made it semi-monthly, or you know what I mean?
Yeah.
Like everything else is, and say, okay, you know what? Instead of us confusing you between SIXY and bank, I'm gonna take bank, which pretty much is what SIXY is.
I think
And
SIXY is part of their, because they have Biggie and Canny as their ultra yield,
yeah, that's true.
right? So
They
they're
have a
kind of like
higher
they're building a new suite of
yeah.
ETFs, right?
Yeah, maybe that's why they're doing it, because they do have a higher leverage. I think
Leverage, right?
they're doing the 33%
You
or
know,
30%.
you know what I'm wondering, and maybe I'm wrong. How come in the States they don't seem to have any sector specific ETFs?
Very little. Like, yeah, they don't. Now, I shouldn't say that, because watch my video when I did that reboot of the US cover call ETFs that
Yep.
are in the core base foundational. There are some out there, but they're a lot more obscure. Like State Street had some, Amplify had some. Like, they are out there, but we don't talk about them much. So there were things like industrials. There was one on healthcare. There was one on gold and silver. So they are out there, but you really got to dig for them. They do exist, but they're not that popular. In Canada, the cover call ETFs that are sector are very talked about. Like, everyone talks about them.
Yeah.
But yeah, well, first of all, nobody, like in our community, how many people talk about the cover call ETFs from State Street?
I never heard of it.
Yeah. Well, there was one even worse than that, Paul. If you go look at my list in the video,
Yeah.
there's a one called what was it? Yield. Can't remember what they were, but they're ETFs. They only have like 3 or 4 of them. They're eggy. Oh, Yield Nest, because it's like a nest.
Yes, I heard about Eggy. I heard about Eggy. Yeah.
Yeah, there's Eggy, EGGG, or well, there's only have 3 or 4 of them.
Yeah.
At first, when I watched the YouTube channel, or I looked at their website, it's like I'm almost on a cartoon website. Like,
yeah,
it looks so funny. But yeah, like, there are cover call ETF companies out there, emerging ones that just are like very boutique-ish, that are doing certain things like that. But I don't think the general social media influencers of cover call ETFs are actually taking note of them. So,
right.
But they're there. You just got to look harder for them. And so it was funny when when I did that first video on, here are some cover call ETFs that are good for base core, because they're generally not that popular in the United States. And you gave me a few of them, like Tap Alpha and NEOS. Well, that's when all my American ETF investor viewers came out and said, Perry, you forgot about State Street, you forgot about Amplify, you forgot about Yield Nest. Like, I got a whole pile more from there. So actually, I built out a pretty big list.
Wow.
On ETF companies I didn't even know about, like, or I didn't even pay attention to, right? So,
yeah, there's so many, right?
Yeah,
there's so many.
It hurts. Yeah. So my strategy for 2026.
Yeah.
I already told you one of them. I'm looking at likely, and it's going to be a very subtle move. I'm going to be basically doing reinvestments more to yield base and more to core base. And I'm going to actually cut down on my investments of the juicers. So that's going to be another 2026 emergence. The second thing I'm going to do is I'm going to experiment with something I did once and I got out of it really quickly because it was too confusing. But I think I'm going to do it. I'm going to, for the first time, actually go really back into non-registered cover call ETFs. Holding them in my non-reg, which I know other people are like, well, Perry, I've been doing that all my life here already. So,
yeah.
But for me, I avoided it because I didn't want to deal with the ACB calculations and how does that deal with tax and the T3s and the T5s and all that. So, but I figured, you know what? I've made so many capital gains on my Athabasca oil. It's just crazy that I have this large cash position and I don't want to just sit on it. So I thought to myself, instead of just sitting on it, why don't I put them into income ETFs and let them start? I'm not going to do American ones. I mean, I think I'm going to focus on Canadian, moderate type of cover calls. And I'm going to start doing non-registered income portfolio. So,
okay.
Yeah. And then the third one I'm going to do, and it's more of a tax strategy. I'm currently, because the growth investors talk about this 4% rule, and maybe with the right growth stocks I can erode it so I can actually go up to 6-7% if I got the right stock. I'm conservative right now at 12 to 13% withdrawal rate. My withdrawal rate as of 2024 and 2025 has been 13%. I'm going to move it up. I'm going to move it up to about 15-16%. I'm going to be withdrawing a lot more per month next year, because I consider 2025 to be more of a NAV growing year, where I basically held back my withdrawals and I used more to reinvest. But I think in 2026, I'm going to be actually just holding my NAV stable and basically take out more money. It's going to hit me more with a tax. I'm going to be taxed more, but I'm going to be taking more money out. So
nice.
And see how that works. So that's going to be my 3 big goals for 2026. So
how maybe this is not as difficult as I think, but when we're getting our distributions, our dividends, right, and our yields are 30% or whatever it is, how do you figure out that you want to say withdraw 12% or 10%?
People have asked me that.
You make $50,000 this month. You just take out 5,000 of it, and that's 10%.
Yeah, pretty much. If 50,000 is what you make for the entire year, if that's your entire distributions for the year, well, hang on. No, that's not what it is. So you have to say how much of your NAV are you taking out on an entire year. So let's say you have $1 million and you want to do a 10% withdrawal rate. That means that you're going to take out $100,000. You're going to take out 10% of your of your NAV.
Okay.
Is the way. That's why I call it a withdrawal rate. And again, it's basically the same as what the growth investors are like saying. Well, the 4% rule is how much of your current NAV are you going to remove, right, from the NAV?
I wonder
so that you can make sure you grow.
When do they, like, for example, your portfolio could be $1 million today, and 20% drop in the market, you could be at 800,000.
Right. So you should really be adjusting your withdrawals to match that, right? I mean, otherwise your withdrawal rate's going to go up because you're taking the same $10,000 a month out on a NAV that dropped. So, but generally on an average basis, when I say I have a 13% withdrawal rate, that means I'm taking out 13% of the current NAV of the NAV is what I'm taking out, right?
Okay.
And then you're hoping, your strategy should be that you could grow your portfolio as much as you're withdrawing. That would be perfect for a retiree, right? What's even better for a retiree is if your portfolio is growing more than you're withdrawing from it. So your withdrawals are pulling down your NAV, but your reinvestments and growth is growing it.
Yeah.
So the reason I'm increasing my 2026 withdrawal rate is because I don't want to, I know people are going to laugh. I don't want to grow my NAV anymore. I want to try to keep it stable. I'm retired, right? Yeah. I just got to have my NAV last 30 years. Well, if it stays stable for 30 years, it's going to last for 30 years, right? I don't, it could go down, but I want to try to keep it just stable, which means I can increase my taxable withdrawal rate. It means I'm going to be hit with a higher tax rate, right?
Yeah.
So what is that number? My point would be is reverse engineer it, right? You got to first turn around and say, well, Perry, how much does your family need on a monthly basis in expenses, right? So forget about what your withdrawal rate is. You got to first define how much do I need? If I need safely, let's say you normally need $5,000 a month to pay all your bills, pay the gas, go on a couple trips, whatever. And you're like, okay, that's okay. But I think just to make sure that I have it when the hot water tank goes or your daughter needs something, I want my monthly expenses to be, say, $10,000.
Yeah.
Okay. So anything from there on, it says, okay, so I got to make sure that I could withdraw $10,000 a month, right? Well, okay. Well, if my NAV is 100,000, I'm taking out 10,000 a month. Well, pretty much I'm going to go bankrupt, right? Because I'll be out of money before the end of the year, right? But so you have to turn around and say, well, if I'm taking out $10,000, if I have $1.5 million, well, then you can do that. It's going to give you about a 20% withdrawal rate. You have to sort of calculate that out, right? So it's all a bunch of re-engineering and saying, if that's what I need, can I first of all afford to retire? Well, that would be the first question, right? Because if that's what you need, and yet your portfolio is only at $200,000, but you need $10,000 a month, chances are you're not going to survive too long, right? Because
Yeah.
you're removing $120,000 a year out of your portfolio, right? So it takes math to do it, right? And that so to me, right now I'm generating the kind of yield. So that's the other reason why my goals sort of say that I have to have a yield of say 30-40%, because I want to make sure that I can do that monthly expenses, but I also have that ×3 formula, which so I have to be able to generate 3 times more than my monthly income, right? So that when we have bear markets where it goes down and it goes down 30-40%, I'm still getting my monthly expenses of $10,000 because my income only got down to $20,000 a month, as opposed to down to a level where I can't even pay my bills, right?
Yeah. Yeah.
Was that too confusing?
No, I think I'm just going to have to sit down and do a little bit of math.
Yeah. Well, and again, people say, well, if I can't do that, well, I'm in trouble. No, what it means is you should, like, this is what I try to tell people when they ask me questions in private messaging is, how do I know how much to withdraw? You ask the right question. Well, you need to sit down. You and your spouse need to sit down and find out what is it you need to live off of. Like, what's considered a safe monthly expenditure, right?
Yeah.
And then say, if I need $6,000 a month minimum to survive, you better be saying it's actually going to be 10,000, because you're going to need a buffer when your car breaks and stuff, right? So if I need 10,000, and then you reverse engineer the whole thing and say, wow, if I need 10,000 and I'm only at $400,000 and my yield I can only attain maybe 20%, I don't have enough money to maintain it. Yeah. Then you have to turn around and say, I have to wait longer to retire, or I have to turn around and find other forms of income, like a part-time job. Like, at the end of the day, you got to meet your monthly expenses. And if your portfolio can only maintain half of that, then you're going to say, okay, I got to keep growing that, and I need a part-time job. I can't retire right now, right?
Yeah, or I guess depending on your age, people have to factor in their Canada pension plan, your
CPP,
your OAS,
yeah, all your external sources.
Yeah,
you're right.
There's lots of ways to make money, right?
Yeah, there's many ways of bringing money in, right? Become YouTube channel. But I mean, you're right. The idea is, at the end of the day, you have to pay your expenses. So you can't turn around and say, I'm going to retire. That's it. I'm going to retire. No, you have to decide if you could retire based on what is your monthly income requirements, right? If you need $10,000 a month, I'm just using it. Let's say you only need $4,000 a month to live, and you'd be living happy with $4,000 a month. Well, okay, that's about what, $48,000 a year.
Yeah.
Okay. Well, $48,000 a year. Well, if you have, say, 480,000, that's 10% of 480,000. So can you maintain a 10 or 20 or 25% yield, right? Like, you see what I mean? Like,
yeah,
it's all reversed engineered up. And if you say, no, you can't, but I do want to retire. Okay, I'm going to work for part-time. I'm just going to tell my boss I'm only going to work 3 days a week. Well, now your $4,000 load on your investments only has to be $2,500, right? And it can maintain that, that kind of thing, right?
Yeah. All right, Perry. Well, I think we kept people long enough.
Yeah, we did. We talked too much.
I'm definitely going to be one of the ones sending you messages on Blossom. Hey, Perry. Okay, my portfolio is 400,000. How much can I withdraw?
Yeah. Figure it out for yourself.
Reverse engineer this for me.
Reverse engineer it. Yeah. I don't want to deal with it. Hey, I'm going to say, bah humbug.
Yeah. Do it yourself. All right, Perry.
Anyways, it was a nice coffee chat. I know it's long-winded, and people, I'm going to try put chapters in this for both of us. And I think we'll likely see you in the new year. So for you and everybody else, have a good Christmas and happy holidays to everybody, and a good New Year's Eve and stuff like that.
Yeah, definitely. All right, Perry. Take care. I'll talk to you soon.
All right. Talk to you guys later.
Yeah. Bye for now.